It's a historic week for gold as the yellow metal has breached all-time highs, past its 2011 highs, setting new records. Joining me today are two very special guests, both who have been very bullish on the yellow metal for quite a while, and both whose predictions have come true. Joining me today is Jim Rickards, best-selling author, and Peter Schiff, CEO of Euro Pacific Capital. Gentlemen, it's an honor to have both of you together at the same time. Welcome.
Thank you.
Let's start with you, Peter. You've called for gold to hit much higher levels for quite a while. Tell me about what your initial reaction was when you first saw that 1900, 1920 level this week.
Well, I'm surprised it's actually taken this long to get here, because the last time we were in this area, it was 2011. And a lot has happened in the last decade almost. We've certainly printed a lot of money. And I think the world should now be able to figure out what should have been obvious back then, but wasn't for whatever reason. And that's that the Fed has moved into a policy from which it can never extricate itself. When we went to zero, when we did QE, people initially thought it was temporary and that the Fed could normalize rates and shrink its balance sheet. And I said from the beginning that that was impossible. And I think the markets are now beginning to realize that I was right about that. And when they contemplate a future of endless money printing and 0% interest rates forever and multi-trillion-dollar deficits funded by the Fed's printing press, it's starting to sink in, and they're getting rid of their dollars and they're buying gold.
Jim, you as well, you've called for new highs for gold. Tell us about how the current price level fits with your macroeconomic thesis.
Well, it's a big increase in particularly a pretty short period of time. Peter's right, it's been a long haul from 2011. But the thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. The euro is now $1.17. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So they're just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. Lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. It's a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes, and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base. So you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit.
Peter, do you agree? Can we be seeing a 50% retracement before prices rally more?
A 50% retracement of what? What movie are you talking to? I think we've already seen the big retracement of that original bull market that Jim talked about, where gold went from under 300 to just over 1,900. I think we've now formed a very solid base really between about 1,200 and 1,500, which is where gold was trading for most of those years since it peaked. And now I think we've broken out of that range. I think we've taken out the highs. I think it's another leg of the bull market. I don't think there's going to be any significant pullbacks from here. I mean, there'll be pullbacks, but I don't think they're going to be very significant. I think if you're waiting for a big drop to buy gold, you're going to wait a long time. And when you finally get it, I think it's going to drop from a much higher price than it is if you just bought it right now.
Yeah, I agree with that. When I was talking about retracement, we had it. The retracement's over. I'm not forecasting a retracement. Quite the opposite. I think it goes a lot higher from here. My point was that we had the retracement between 2011 and 2015. That's done. Now it's just onward and upward.
Yeah, the thing about Jimmy Rogers, though, I ran into him at many conferences, and he was waiting for a retest. I mean, Jim was waiting for gold to go to 1,000, and then he was going to buy more. I kept saying, Jim, it doesn't make sense. It's too risky to wait for 1,000 because it may never come. And of course, it never came. And then there were a lot of people who were waiting, for 1,200 when it was at 1,500. I mean, the world is going to be full of people who are waiting to buy gold and who are broke because they didn't just bite the bullet and buy it.
So I've spoken to an economist recently who told me that if you look at the last time that the Fed expanded its balance sheet on a significant level during the last recession, what we saw was gold rising in tandem along with the expansion of the Fed balance sheet. In fact, during the years 2009 to 2011, that 3-year period, gold rose 200%. And so if we apply the same growth metric to today's situation where we also have the Fed expanding its balance sheet, what we're going to see is a $4,000 gold price target. Could this happen? Peter, let's start with you.
Well, remember, too, the only reason that gold stopped rising at 1,900 was because the world was convinced that the Fed could unwind the policy, that it could normalize rates, that it could shrink its balance sheet. Had the market not believed that, then gold would have kept rising. The way they were able to stop the price of gold from going up in 1980, that prior bull market, was because Paul Volcker did the right thing and let the market set interest rates, and rates went up to 20%, and that broke the back of that gold bull market. Well, what's going to stop gold this time? They can't let rates go up because we're too broke to afford it. They're not going to be able to bluff that they're going to raise rates in the future because no one's going to believe that. They're not going to be able to pretend they can shrink the balance sheet because if they couldn't shrink it when it was $4.5 trillion, how are they going to shrink it when it's 10 trillion or 20 trillion? Who knows where it's going? So I don't really see how there's any way that they can stop the dollar from collapsing. In fact, in 1971, that's when we went off the gold standard. And the dollar got marked down sharply in the decade ahead. It lost about 2/3 of its value against the euro. I mean, not the euro, the Deutschmark, the Swiss franc, the Japanese yen, and it did even worse against gold. But I think now it's not just the dollar severing its ties to gold. It's going to be the world severing its ties to the dollar. The world is going to go off the dollar standard and back on the gold standard. And I think that this is going to be a more precipitous drop in the dollar's value than it was in the 70s. And so we could see something equally as impressive in the price of gold.
We're going to talk about the dollar in just a minute, but Jim, let's go back to the first question here. Where do you think gold is headed from here? Are we overheated? Do you see more room to climb?
Well, we're not overheated at all. I've got gold at, I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, and 7,000 first. So there's plenty of room to run, plenty of room for profits. But, when I say things like that, David, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and, for publicity because I could care less. But if you just took the average, and there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025, and at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, going to Peter's point, I don't know if there'll be a gold standard or not, but I do know that gold will move. The price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less. You come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years.
Of course,
that's what
Jim,
I expect.
It's a moving target because between now and then, there's a lot of money that's going to be printed. So who knows where the price of gold has to end up by the time we finish all the money printing.
That is correct. It is a moving target. The numbers I gave you are based on current levels, but Peter's exactly right. You keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't. You're going to need a progressively higher price of gold. One thing people forget, David, is that they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar. It's real money. It's nice to make the money. But, if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. I mean, you can do that in a week. So my point is, it's still $1,000 an ounce, good for the holders, but the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 11, 12, it gets to be a progressively smaller percentage increase, and therefore more likely. You need to see it logarithmically to see it on a more a less hyperbolic curve. So logarithmically is the right way to think about it, but in dollar terms, the percentage increase gets to be pretty small at those levels.
Yeah. Well, another way to look at it, Jim, is just look at the price of gold in relation to the Dow Jones, because you have historical reference points where twice in the prior century at significant bear market lows, the Dow traded down to a single ounce of gold. 1932, the Dow Jones was roughly equal to an ounce of gold. And in 1980, the Dow was roughly equal to an ounce of gold. So if you look at where the Dow is now, around 26,000, and figure, well, where would the price of gold have to be equal to the Dow? Well, at the current price, 26,000. But maybe if we get a big bear market, those two could meet around 15,000. And so you'd have the Dow Jones at 15,000, which is significantly below the current level. And you'd have gold much higher. But of course, if they create massive inflation to prevent that stock market bubble from deflating, it's possible that an ounce of gold and the Dow could meet at 50,000. I mean, it does, the key is that they're the same price at some point, not necessarily what that price is, but that they're the same.
That's right. And David, when I say $15,000 an ounce, I don't think I'm stretching. I mean, Peter's right. Could it be 25,000, 40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. So Peter's right. My numbers, I think, are conservative. They could be much higher.